Hi, everyone. Good afternoon. I hope the week has been treating you well. Welcome to the 16th edition of Evenco's Trend Watch. Today, solely focused on fixed income. My name is Renato Prieto, and it's an absolute pleasure to be your host today. But first, before we begin, we must give a word of praise and recognition to Evenco for giving us this debate space, this safe space where we can discuss trends in asset management, in fund selection, and try to bring the most interesting people to discuss some of the most interesting topics. So I hope you guys enjoyed this, and thank you, Evenco, for allowing us for putting these all together. I would like to note that Evenco not only organizes online events, but it also organizes live events. So you could go and discuss old ideas with old colleagues or hear new ideas from new friends. It's also a great place for networking. And to be honest, like, you can come and meet the humans behind the webcam, which would be a pleasure to meet you at some point. This is not a simulation. I can tell you that if you check on the events page at evencointernational.com, you would find that the next events are on the 7th of March in Copenhagen, and then in Stockholm on the 14th, and then here in London on the 18th, not of March, but of April. So do have a look. There's plenty of locations. So somewhere between Lisbon, Oslo, and Chicago, I'm sure at some point Evenco will be down the road from you. So this event is not only powered by Evenco, but also by Bloomberg Intelligence, which is the research arm of Bloomberg, of which I'm glad to be a part of. Bloomberg Intelligence hosts about 475 investment professionals, covering everything from, say, interest rate strategy to single name credits, and then all the way down to, say, EMFX and litigation. And it's freely available to any Bloomberg terminal user. You can find us on BI Go, or to make it even a bit more relatable, please feel free to drop me an IB later today. So let's get moving. First housekeeping rule is please keep Q&A coming. We will try to insert that in our conversation as we go along, as much as we can. And if not, there is some time later at the end where we can tackle questions that were left unanswered, or even as answers to questions will lead to new questions, we will look to tackle those then. Secondly, and most importantly, let's take a tour through our panel. And I would ask our panelists, as I go through them, to please, introduce yourselves, explain a bit about your background and what's been keeping you busy lately. And I guess I would start with you, Olivia, please.
Oh, okay. Thank you, Renato. Right, I'm a family office lawyer at Kingsley Napley, based in our Moorgate office here in London. And despite the fact that I've got the Golden Gate Bridge behind me, I am actually sitting in our Moorgate office in London at the moment. So I deal with single family offices, structuring, setting up single family offices, and then becoming their legal representative. Where are we investing at the moment? What is our concerns? That's really what's happening at the moment. That's what's keeping me busy and keeping me awake at night. Clients in not panic mode, I would say, because I try not to let my clients panic, but certainly concerns, shall we say. Going forward into 2024, we see some quite alarming trends that we are now factoring into our planning. But I'm sure we'll cover that.
Yes, perfect. No, that's a good place to start. Great. Next, I would go into Ben Ashby, CIO at Anderson Rowe. Ben.
Hello, everybody. Just first of all, thank you to Evenco for having me on. And I'd like to say, anybody listening in, it's a great organisation, and the fact that they allowed me to go on here shouldn't be seen as any reflection of their wider judgment. So I'm the Chief Investment Officer of Henderson Rowe. We're a private wealth manager based in West London. Prior to that, I was exiled in Canary Wharf with one of the large US banks that's very well known. And I ended up working in their Chief Investment Office, which managed a lot of their own long-term investments. My current company is owned by a US firm called Radiant Global Advisors, and I also head up fixed income for the wider franchise.
Perfect. Great. Well, it sounds like the beginning of a great mix. And then I also have Louis Gargour. If I pronounced that correctly. Louis, floor is yours.
Yes, thank you. And I'd like to also thank the sponsors and for having us on. I am the Chief Investment Officer of LNG Capital. We are a fixed income hedge fund. Prior to that, I've worked at Goldman Sachs and JP Morgan in senior roles. And what I look at is where there's value, including investment grade, government bonds, credit, and derivatives. So we are a fixed income boutique focusing on European markets.
Perfect. Good. Well, there will be plenty to talk about. Moving on to the conversation, I'll try to set a bit of context, which, and I will, not be ashamed of that, comes from our global rates outlook here at Bloomberg Intelligence. We do publish 85 pages of pure fixed income pleasure for those interested. And I'll take these a bit as a basis for our conversation as a starting point. So please feel free to enrich the content as we go along. And I have expressed these to you guys before, is I do feel that it's that these event happens with great timing. So in a way, we've had a decent month of issuance back in January. In a way, also the rates curve is somewhat exhausted of pricing rate cuts that don't seem to happen, or at least that clash with central bank rhetoric. And I would even caution that, for example, if you try to do this on Bloomberg, you can, for example, track how many cuts, but I would add that that's just an average. So if you would look into the options market, currently for the US up to the end of the year, there's a probability of between 10 to 15% of rates actually being higher by the end of the year. So things have changed a little bit. And I guess even bigger picture, if we wanted to go global as that, you could see that across the G3 plus, if you want to call it that, so US, UK, Eurozone, and Japan, you'll find that monetary policies are not necessarily as correlated probably as they used to be before. And that kind of creates some interesting dynamics that might interfere with the need to refinance the upcoming issuance, be it sovereign or, I guess, topically high-quality corporates. So having said all that, first question, I guess, would be is not where were you when the pivot was obvious, but what did you think of, and what was your thought process when throughout the last quarter of last year? How did you think about it, and how did you position for it? And I guess I'm asking that as a segue into, does the current point make you think about that, in the sense of economic data is now suggesting that the rates curve is going to be of a different shape? So I guess I would start, Olivia, maybe.
Oh, me again. Sorry, I was just busy listening there.
If you don't mind.
Okay. End of last year. We saw an awful lot of talk about rates. 2024 being the year of the bond, and 2024 be the year of the rates cut, and I couldn't actually see the data that would actually point to it, because inflationary pressures really for me sort of saw globally, even inflationary pressures, I couldn't see where the rates cuts were actually coming from, where their data is that they could back up this phenomenon that by the first, within the first quarter, we would have certainly a substantial rates cuts in the US, which of course we haven't really seen. And now, of course, it was moved from March, and then it was now moved to June, and now it's the second half of the year. And as you said, we're even now looking potentially of a rates increase, which we certainly didn't see before. So I think the trouble at the moment we have too many drivers in the market. And for the end of last year, we was a caution. For my clients was more being cautionary and not sort of jumping on the very sort of optimistic, shall we say, bandwagons that would seem to be coming about, which tend to be in the last quarter, to be honest. But last year was particularly, I found that way. But that's just me personally. But
sure.
What do you think, Ben?
I get the feeling the way you've done that hospital pass to me that you want me to answer it in a, shall we say, engaging manner. So,
well, because you're going to say exactly what I want to say, but you're going to say it in a nice, shall we say, polite manner.
Okay, with that guidance, I would optimistically, well, I'd point out that none of the central banks have any functioning model of how inflation works. You can check that. Governor Tarullo, when he left the Federal Reserve, basically pointed out they have no functioning model for how inflation works. So therefore, nobody else in the market has any functioning model of how inflation works. We've also got the fact that the Fed itself, in its various disclosures, has pointed out that its general model for the US economy hasn't worked in any real capacity since the mid-90s. So that's another minor problem that they're going to have to overcome. We had Mervyn King being interviewed on a podcast earlier this year, who's actually been very interesting over the last 2 years, pointing out some of the issues around central banking. But he pointed out that the main reason why they think inflation is going to come back to 2% is because the models are set to show inflation coming back to 2%. So there is no other basis to it than that the models come back to this equilibrium position. And the small problem that even though they are central banks and they are responsible for monetary supply, they exclude money for a lot of their modeling, which is largely done for political reasons left over for monetarism in the 80s. So against that, shall we say, somewhat challenging backdrop of what can only be described as mysticism or shamanism coming out of the central banks, I'm not entirely certain why anybody should be listening to them. The story of the pre-GFC was obviously banks behaving badly, and ever since then we've had central banks behaving badly. And then we finally got the backdrop of there's no fiscal control pretty much anywhere in the Western world. We've got an aging population that hasn't been funded for, and we've got absolutely huge amounts of debt to finance, and it's just increasing every year from now until ever till we get a financial crisis. So my humble position,
I guess you're short.
I would just say it's a question of when things go wrong, which could
rather
well be
than if,
whether it's 2 or 3 years.
The technical term is these days is underweight, isn't it?
I was going to say, is it a short or
Bloomberg doesn't let us
underweight?
say short anymore, right?
Yeah, I'm long pineapples. Tin pineapple. What can go wrong with them?
Guns and water, I think, is the ultimate hedge, right?
Yes.
So,
but Louis, what do you think? I guess
so
coming from a more hedge fund side, I think.
There you go. I mean, look, I can look at any asset class I want, and I looked at third quarter, fourth quarter of last year, and I thought to myself, with the committee said, if rates stay sustainably high, let's say higher for longer, as the Fed was saying, what asset class does that impact? And I think that impacts investment grade somewhat, and it impacts high yield quite significantly and emerging markets. So you'd expect those types of issuers not to be able to sustain those high costs, and you'd expect those business models to be affected. So if you're going to play rates and you think rates stay higher and then they come down, you move to a liquid asset, you move to something that is actually a curve trade rather than curve trade plus a spread in credit. So we came out of credit and we went into investment grade government bonds. And government bonds for most investors are great because they're tax free. So if you buy gilts and you buy treasuries and you lock in 5% yield for 5-6 years, that's a good trade. The second real question is, what does it do to equity markets? If you have higher rates sustainably longer, a lot of the equity big players are also in the debt markets. They need to finance. Their cost of capital is bond cost. So I was concerned that the rate staying higher for longer would cause a recessionary type of situation with a lot of zombie companies, a lot of low quality issuers having not the default because of a business cycle, but because of a cost of capital. So, a slight downturn, higher sustained cost of capital, that doesn't benefit high yields at all. And so that was one of the underweights or shorts. Government bonds was one of the longs. But I agree with what everybody has said, which the world is not a wonderful place anymore. But that being said, higher rates, you can make money if you lock in risk-free type of securities.
Right, and those are very, very good points. I guess this is a bit based, as I was saying, from the view from before and the view from now on. Does the fact that rates seem to be a bit stickier up? Or do you make a geographical distinction? Because that's one of the topics as well, I guess, is monetary policy and yield curves are trying to go in different ways. So we've seen data from the ECB, we've seen data from the US side, and data and central bank comments from the Japanese side. The whole thing seems to be a bit apart. So does the fact that, for example, in the US now there is an expectation that rates might be kept longer higher for longer. Does that change that view, or does it increase your conviction on that high yield underweight?
Well, I think it's regional. I think you can't. Well, first of all, Europe itself is regional, but we have one central bank. The U.S. has the jobs problem, right? The job market stays hot. The U.S. can't do anything with rates. Europe has got the slowdown in the economies. Germany is now not showing growth; it's showing negative growth, and it's showing all the usual signs of people, big manifestations. There's all kinds of subsidies are being fought over, et cetera, et cetera. So I don't think the ECB and the Fed are on the same path, and they're not on the same path because of different reasons. Bank of Japan, it's a complete outlier. I mean, let's leave it aside for now, right? And then in the middle is the Bank of England. But then if you say to me, what currency are you going to invest in? Who's going to be first to cut rates? That's going to affect my FX as well, right? So first guys to cut rates aren't going to do well in the currency market. So maybe the Fed is slower to cut rates, ECB is sooner to cut rates, euro weakens, and you might want a dollar investment because your rates stay higher for longer in the US.
Right. Yes. Anyone
Just a thought, right? I mean,
no. It's a topic I intended to raise, given that a synchronicity between policies is that if you look today and you would fully swap and fully hedge a Japanese government bond, currently yields above treasuries, and given the participation of
on a total return
Japanese investors on the US treasury,
are you hedging currency as well in that assumption?
In that assumption as well, yes.
Okay.
So I was wondering if anyone wanted to grab that and have a global view into it, because obviously it also strikes that if there's a big stock of debt coming through to be refinanced, you're probably going to have to tap more into A, retail, and B, foreign investors. But if it looks bad from an FX perspective, then what's the cost? What happens? I don't know, Ben. This feels along that alleyway of macroeconomics. And
it sort of depends on who the investor is. So if you're working in a large leverage financial institution that's regulated, you rarely get fired for buying your own government's bonds, because if the country is going down, then your institution's probably not going to survive either. So you tend to see this death embrace just before the end. I would say actually Japan is one of the most misunderstood potential risks in the market. They've effectively financed a lot of that dollar borrowing over the years. And if domestic rates become a much more attractive bet for them, a lot of those regulated institutions are highly incentivized to buy domestic debt, and therefore would start unloading some of the US positions they've got. The other thing that you've got as well with the American market is they've done a pretty good job of alienating some of their overseas investors. Obviously, Russia will no longer be there for them. China is probably deteriorating for various reasons as a potential buyer, but you've always got to see that that's partly a function of, if China wants to run a massive current account surplus, then it's always going to have to accept somebody else's currency, unless we're going to move to some kind of gold back or some other hard currency sort of backed world. So somebody's going to have to end up running that if that's what China wants to do. I'm absolutely agree with Lewis that I think that there is some regional sort of things going on. Effectively, Europe and Asia to a certain amount has massive industrial overcapacity. So therefore, there is a reasonable chance they are more prone to deflationary trends. And you've got, in the Anglo world, us living on the never for the last 30, 40 years and borrowing money to do it. And then therefore, that rebalancing of trade deficits is likely to prove inflationary.
Ben, do we inflate out of those trade deficits? Can the standard argument is inflation works in your favor.
Exactly.
Inflation works, sorry.
In your favor
when you're trying to basically inflate yourself out of your debt.
Yeah, it is. But the 2 points I'd say there is, it's like the old joke about taxation. It's getting the maximum amount of feathers out of the goose without it squawking. So if it's so abusive that people can actually see, like they have over the last 2 or 3 years, that their basically personal wealth is deteriorating, then you are going to have a problem. But you can just see with revealed preference, they've got no other way to get out of this. You're pretty much hitting the limits of taxation in some of those countries. You've got the chance of the next thing they're going to have to do is start looking about cutting some of the welfare state benefits, or whether it's defense benefits in the US, or expenditure, I should say, in the States. So they're also going to have.
But that's not going to happen, Ben, in the current climate. If any government who starts cutting in the Western Hemisphere starts cutting defence now, I mean, we've just got massive NATO exercises going on in Europe. If you start cutting defence spending now, it's not going to be popular. No government's going to do that because in Western Hemisphere, because it's certainly not going to be a popular move with the voting public. And let's face it, they still care about what the voting public think of them, because they've got elections to follow.
I agree with you, but at the end of the day, tanks don't vote. So
yeah, but people do, and if they feel that you're cutting their I mean, at the moment, people are incredible. If you ask people on the street, what are they fearful of? Your average bod on the street, they keep coming back with World War III. Now, however we think of it, that doesn't matter. The government thinks, Mr. Bod on the street thinks we're going to have World War III. If I cut the defense budget now, even the US government's not going to come in and start cutting the defense budget. It's highly unpopular.
Well, I work with a consultant who believes that we are already at war with China economically, and it's only a matter of time before we actually have some sort of physical war around Taiwan, et cetera, et cetera. Assuming that everybody, so back to this central bank argument, if you assume that everyone's got their best interests at heart, right? They don't want to be first to cut because it weakens the currency, but then maybe that helps them in certain ways to export. So I don't think central bank action is coordinated anymore, because I think the first to cut will have a knock-on effect in FX, and will also be seen to be the country that basically is growing slowest and had the cut, so to speak, right? So it's almost an admission of guilt.
Yeah, yes, that's a good thought, Louis. I would perhaps, well, moderators don't usually give their opinions.
Oh, come on, Renato. We're going to ask you for it. Come on.
Yeah, come on. We all are giving our opinions.
No, I do agree with that. The interest rate differential obviously is perhaps one of the strongest short-term drivers. But then I guess on a medium term, it also depends if the trajectory is going to keep to being that one of divergence in policy rates for you to have a consistent FX effect. And then there's also, and this is for the macroeconomics people in the room, it's, if you spur growth through that interest rate cuts, and obviously we're talking medium long-term stuff, then you could argue that in the long term might affect effects. But agreed, we can even argue that, and that's actually a point about the geographical disaggregation that we are seeing, is that perhaps in Europe, you're seeing, the data is about to force the ECB's hands much more than it would force in the US or in Japan, for example. And so that would be interesting to see. I'm curious, and Ben, given the more or the lesser optimistic, cautious optimistic, or maybe the reverse of that, how would you express that view in terms of fixed income asset classes, or even or feel free to go a bit more general asset classes? So are we talking about, absolutely just I'm sure it's not 100% T-bills, but how would you approach asset allocation given that view?
Yeah, I think some of the equity classes remind me of this when it all goes wrong. But I relatively.
It is a recorded webinar.
Yeah, I know, with witnesses.
NVIDIA.
So no, I'm not.
Remember 01, Ben? Were you around in 01? I was around in 01.
I think you were shouting at me in 01 because when you were at JP Morgan. So no, I think you'd moved by then. So NVIDIA doesn't half look like Cisco. Do you remember the final days of that?
Dark cable.
Yes.
And,
exactly.
Yeah, God.
So anyway, moving swiftly on, I think some of the emerging market asset classes, some of the emerging market equities still look relatively attractive. They're at a relatively deep discount. The trade-off that we've made is relative volatility. So we're likely to get more volatility because we've gone down there, but actually we think the risk return on a longer time frame looks more attractive. I don't really want to take a lot of duration here. I appreciate historically what's going on and the almost certain large deflation of asset prices in private equity and commercial real estate is generally deflationary for the US economy and other parts. But I'm just unconvinced with the current fiscal spend. And again, talking about sort of old war stories, but a lot of this reminds me post GFC, where I thought there was an emerging market style crisis coming in the Eurozone because you had all the key features of it and nobody thought it was possible because they were developed markets. And I hear a lot of that. It could never happen in the US. They've never had these problems financing it before. Well, actually, from a historic viewpoint, if you go back to the 40s, the US did actually have problems financing their deficit, which is why you had the original twist and financial repression that was exercised then. Just one last point I was going to bring up last time, but just looking back in history, but when the UK did a big devaluation in the 1960s in the world of fixed exchange rates, the exporting companies looked great for about 2 years, and then the workers had realized they'd been screwed in real terms, and then you start to get inflation coming through. So the point with that whole sort of deflating or inflating your currency out of it is problematic. You have to inflate against somebody else, and it will come through at some other part in there. And I'll take your point about defense, Olivia. It's just when you look at welfare benefits or universal healthcare and stuff like that, I suspect that probably features more for the average investor than defense.
Olivia, I've got a question for you about since family offices is your kind of your speciality
area,
and you know those guys are very heavy private equity, direct lending, you know, some of the smaller kind of venture capital deals. Are they getting paid a sufficient illiquidity premium to take that risk? Because I think that, you know, you look at spreads and you say spreads over risk-free is what bonds do. You look at illiquids, you say, what's the illiquidity premium plus the spread for that implied rating? I think it's tight on a historical basis. Are they happy to hold it, or are they trying to get out of a lot of these names that may not be so liquid right now?
Well, I don't want to cause a panic, but no is the answer. And there is a sort of a beginning to, shall we say, not a stampede, but certainly a move to get yourself out of that position. So definitely there is a move. But you've got to also remember that they're long-term strategies. So they're employing.
Well, they have to be, right? I mean, that's
because we're sort of investing for multiple generations. Generations, you know, I'll be dead by the time some of these generations come through, probably sooner if my bosses hear me saying. But so it's not a general stampede. But there is a move, and there is not a panic, but there's certain concerns. This is what I was saying at the beginning when we came on. This is one of our concerns at the moment. So I would say.
Well, that's what I've heard from my private equity sources is that, you know, since there's not the exits that they were hoping, there's no longer the reinvestment into the new pipeline of upcoming deals type of thing.
Well, this is the point. Because you're not making what we were promised has not become about. Therefore, why bother to reinvest?
Well, you can't if you don't liquidate some of the holdings, you can't reinvest. So kind of private equity and real estate, back to your point, Ben, seems to be in a liquidity cycle, right? You know, and liquidity, being a credit guy, liquidity when it's around is great, but when it's not around, you know, you've got to actually say to yourself, is the asset class paying me enough to buy and hold?
To buy and hold, and the answer to that at the moment is no, especially in certain equity classes. So sorry, Ben, you were asking Ben. Sorry, Ben, I stepped on your toes.
No, I was just mentioning Ben's comment.
That's actually a great question. Because I had a last question for all of you, but it was supposed to be for later, which was potential sources of risk. Unknown unknowns coming in the future, and you already stepped into private credit way faster than I was expecting. I was wondering, Olivia, and still and Louis and Ben, still on that context, what is the substitute for private credit? Is it triple C high yield? Is it
no?
What do they compete to? And what's that illiquidity premium looking like? Do you get 100 basis points illiquidity to never be able to trade something again over the next 5 years?
Well, okay, so the illiquidity premium is exactly that. It's like, how long is it, and how illiquid is it, and how much more are you being paid? It's a function of what the risk-free rate is. Let's say the risk-free rate is 4, right? Let's say the spread is 200, so it's 250. You get 6.5 for a high yield bond. How much should you get for a high yield proxy private equity? 8?
8.
I'd suggest 8's not enough. I'd suggest you need 10 in this environment to compensate for the 20% of your portfolio you might not be able to sell for 5, 6, 7, 8 years. So
Perfect.
I think that the
You're
liquidity.
not going to get 10.
No, you're not going to get it, but you should ask for
You
it.
should be getting 10, but that's what you're asking for, but you're not going to get it.
And then back to the triple C thing. Absolutely not. Triple Cs have been identified as the one asset class that has not responded to rallies in all the other bond asset classes. Emerging markets, double B, single B, investment grade, and treasuries have all rallied. Triple C is sold off because it's likely to go bankrupt. That's why it's triple C, right?
It's I think, as you mentioned in the beginning, it's I guess that place where the zombie companies that you were talking in the beginning, that's probably where they live, and that keeps that dispersion pretty wide in terms of spreads. Right, no, it's good. I'll actually have a question from the audience, which actually fits into this asset allocation conversation, and we haven't touched about it, even though it is extremely relevant. And I will, again, sell a bit of BI research, unsolicited. We have recently put out a piece, conducted. It's a quant piece on ESG, regressing ESG S&P quarterly performance versus ESG factors. And there are some signs that the statistical significance is ambiguous. So wouldn't say they are negative. They are just not positive, or doesn't meet the hypothesis.
That really didn't. You really didn't take a stand there, and that's quite unequivocal.
No. It's
there's no greenwashing going on at all here.
No. By all means,
they are solidly neutral, is their call.
I mean, green credentials. So you're saying it hasn't underperformed, it hasn't overperformed. So it's just tracked S&P.
We held the biggest ESG event 2 weeks ago with.
I saw the conclusions as well. That's why I'm having a laugh.
Yes, So that's why, and I guess, and to the point I was going to make is, well, that's interesting because of obviously from the headline perspective, but also it's just a matter of numbers, right? So if the rally these days is in Nvidia or AI related stocks, they don't necessarily have the most powerful or the most visible ESG score, so the statistics might be distorted for that. But nevertheless,
if you don't have ESG credentials, you can't sell your fund regardless. You have to actually quantify and know and understand the companies you invest in. Now, they may not be ESG compliant, but you need to know their scores and you need to know what you're investing in. So it's almost like you need to know what your portfolio is doing from an ESG point of view.
So, and to that note, so where does ESG investing feature in your portfolios, given the current climate? And this is an audience question.
Oh, that is really going to throw us under the bus if we actually respond honestly. So
can I jump in and just start off to make it easier for everybody else? I think it's great because we've had loads of magical thinking about how physics works in the real world over the last 10, 15 years. We've had massive underinvestment in energy. And it's all going to catch up. So I just want to say thank you very much for all the ESG investors who have divested themselves of fantastic long-term assets at the wrong price. So I suspect we're going to have an energy squeeze. We haven't had any of this stuff that's been properly invested in. Look at the price of uranium, as everybody's worked out. The windmills don't work properly. We've seen that. Who could have seen that coming? So anyway, yeah, look, I'd like to see the world a nicer, safer, happier, greener place, but I think that anything that was driven top-down, almost communist style, was probably always going to be prone to communist-style outcomes of capital allocation. And I think that's likely to start coming through very strongly in the next few years. And I'm also deeply sceptical that the Joe public is going to vote for this. We're seeing the collapse of the political centre pretty much across the world at the moment. People are moving to the wings in terms of more populist parties on both sides. And it leaves me in a position where I'm deeply sceptical that ESG features very highly in that average voter's outlook on a 5-10 year basis.
Right.
Sorry, guys.
I agree. Thank you, Ben. I wish I could.
Discussion.
So, Ben, you take the arrow, okay? You take the arrow, and then we'll nuance our answers a little bit more politically correctly, right? So
yeah. I mean, I have to say, I agree with everything you've said, Ben. I just wish I could have said it. But yeah, so I agree. I think certainly from client points of view, we're seeing a move that is where we had previously anything basically with a green tick on it. It looked vaguely green and ridiculous, as you said, ridiculous hypothesis. No, we'd still invest in it because, it's going to save the planet, or it's going to do this, or it's going to do that. And we're seeing now the consequences of that. Certainly. So yeah, we are seeing people pulling out and being far more questioning of what actually ESG means and what are these credentials. So yes, but I agree with Ben. We've underinvested in so many important aspects that that's not something we're going to get back.
Yeah.
That's a mistake we've made, and now we're going to pay the price for it. And the price is going to be basically social unrest. And that's when I was going to mention, Renato, because you asked me what my big fear is, and massive social unrest, because they are paying the price for policies and investments, or lack of investment in the correct areas, made by not just my clients, but other people as well, and a move to inflict policies that are completely unworkable on your average person, and they are not pleased. And what that leads to is they lead not just voting with their feet, they will actually use their feet. And we've seen that already, social unrest in this. And I'm not talking about sort of Just Stop Oil and the other protesters who have annoyed us all terribly. We're going to see much more social unrest on the question of, why is these policies that are pushing my energy prices up, or pushing this up, pushing that up, price up, and making life unaffordable for your average person. And that, whereas, when I talk about family offices, I'm dealing with ultra high net worth individuals. We still have to think about what your average person is, because the average person is the one who's voting, and the average person is the one who's now getting really angry because they've seen our policies and basically this whole ESG. It's not the question that they are not concerned with ESG and concerned with the green. And as you said, we want a lovely planet and so forth. But what they're concerned with is, putting the food on their table, and how much is their heating bill going to cost. And if they can't afford it, they start shouting and causing problems. And that I don't see something that's going away in the short term, or even in the medium term. I think that's going to increase. And that's something that we have to factor in now.
So the reality is, what you're saying, I think, is that it's cheaper to produce in a reckless and environmentally unfriendly fashion. But ultimately, if that's economically more viable for countries or companies in emerging markets, that's going to bring food or a product to market at a lower cost. In an inflationary environment, that's why the ESG impetus has actually lost a little bit of steam, because people want cheaper products delivered quickly and efficiently. So you're looking at something that's produced in Brazil that may be polluting the environment, but is actually 25% cheaper, is actually serving the population that needs cheaper goods and products. And so the ESG thing is not just about on a portfolio basis, it's on an individual company basis. So I'm not going to avoid sectors that I think are interesting, shipping, oil and gas, because I don't want them in my portfolio. I'm going to try to look at companies within that sector that are more responsible than others, and price the difference, and see if that responsibility is actually making me buy something more expensive than it should be relative to its competitors. So I think the market's become competitive, and that's why ESG has taken a back step, right?
Sorry, Olivia, please.
No, you go ahead, Renato.
I was going to say, I would offer two thoughts to keep that going. One is on an allocation and thinking about positioning and investing. Do you feel that ESG still, despite these dynamics, still added something to the way you think about risk? So I guess, for example, regulatory risk, given from green policies, is much more relevant. It's more present now, or people or risk managers are more aware of that. Things like stranded assets, you have a factory that is perhaps too close to a forest that will grow in 10 years and your factory has to move. So do you think that there's, so I would offer that and try to understand if that added value to enriched your asset allocation process. And I would offer another result from a survey we conducted recently with 250 C-suite and 250 senior investors, where ESG, albeit not 100%, yes, it still matters. We are still traveling in the 75-80% area. So it's obviously not people in the street put foot on the table, but it does still seem to be pretty much there on the corporate agenda.
It may be there on the corporate agenda. What we're saying is the mistakes are being made now and have been made over the last 5-6 years. even longer, probably Ben would say. But we've made those mistakes, and what we're seeing is in coming now are the results of those mistakes. Because regardless of what the corporate sector say, you ask the corporates, is ESG still important? Of course, they're going to say yes. In the same way that because they've jumped on the bandwagon, and they're going to reply, yes, it's important, because God forbid we should actually tell the truth. But this is the point. This is where we're losing out, and that's what Ben was trying to explain. And what I'm trying to say is we're not talking about your average person, but the average person does have a big influence, and we've been forgetting that. And so we've been looking at, certainly within ESG, we've been looking at a lot of variables that actually don't really have that much importance, I should say. That's my importance. That's my opinion.
We could do another 1 hour webinar one of these days on that one. Right. Okay.
Right, Ben, I jumped in on top of you. Sorry.
No, not at all. I agree with everything. I just, the only thing I'd point out is, having seen a few market cycles, everybody seems to get very bourgeois about making money at the top. And I remember in the last cycle, I believe ESG was called stewardship. And then prior to that, it was CSR, corporate social responsibility. And then the holes open up in the investment portfolios. And then suddenly everybody changes their mind. So I'm not suggesting that's just about to happen. But I would be moderately surprised if it was not just about to happen.
Perfect.
Precisely. Thank you, Ben, for putting it so neatly.
Yes. Louise, you want to add anything on this, or I'll have to pivot to, obviously, topical word here, into the next topic, which is also a question from the audience. So we were talking about emerging markets even under the ESG umbrella, but the answer is not necessarily under the ESG umbrella. And I have a specific question for Ben, which is regarding emerging markets, is if you could refine and be a bit more granular in terms of the asset allocation, if possible, down to countries. And personally, for me, down to sectors as well, because obviously, countries it's the spectrum of things you can find in any EM, in the EM space, can vary from a really close to the States, like a Pemex or a Petrobras, or you can end up really far away from the state, or even end close to the state, but also bankrupt in a couple of years. So I was wondering if you could give us a little bit more color, Ben, if that's okay.
Yeah, no problems. So we're something called stock pickers, which probably should be underneath the World Wildlife Fund as soon to be extinct species. So there's bits and pieces in LATAM that we like. Generally, we would prefer debt in companies close to the state, because they're usually horrible investments for to be co-investing with the government, because they're not really in your interest. God believe it, we actually found some stuff in China we like that's doing really well, even though everybody else hates it at the moment. And little bits and pieces in Asia. Generally, it's primary industries, though in Asia, a little bit more secondary industries, bits and pieces of manufacturing and supply chain. So that's where I'd be. I've got no interest in frontier markets. And we're not really big on just investing on a country because we say so. So for anybody that's interested, I wrote a long piece about why Ray Dalio was wrong on China about 3 years ago, about why it was likely to be a really bad way to allocate assets. And then if anybody's interested, if I can plug Nikkei Asia, but there's an article in there that I kind of explain why I thought it was he was wrong and I was right, which I was, but he's a billionaire and I'm not. So who's the bigger fool, really? So it's me, really, isn't it?
Well, yeah. Well, there's a lot that can be said about being right. In Chinese primary industries, I'm imagining exporters, or does that feature?
No, we like some of the stuff that's involved with the EV. I mean, look, they're eating Western Europe's lunch in terms of EVs. Look, I've got
Ben, do you still sorry to interrupt you, but Ben, do you still see the EV market as growing?
No, I don't. Until they sort out the battery technology. Look, we throw phones away after 3-5 years. Look at where secondary prices are coming for EVs at the moment.
True.
It's not like you can fix these things very easily. So oddly enough, given they use largely the same technology, they devalue very quickly. So Yeah, we'll see what happens, but it doesn't mean that there's a certain amount of probably the same corporate execs that say they're hitting their 78%, corridor.
Yeah.
They're putting all their execs into their new cars, and it's somebody else's problem to fix later on.
Right.
Hmm.
Well, as a EV owner, totally, see myself on that. Right.
No, because I say that because we've just sort of seen data on the EV market in the US, for example, has actually sort of correlé, as they say in Italian, just literally imploding.
Yeah.
So,
I think it's in Europe as well. So it's stagnating in Europe. US, I think, was something about Ford pulling the 150 or selling way less of the F-150 that they were expecting for. So yes, the rocket hockey stick growth.
but that's why I'm thinking with China, their biggest export is obviously the EV.
Yeah.
And that's their biggest export industry. So just when you were talking about export industries, that is China's biggest export industry.
Oh, good.
So
I've just got to say, I'm no expert in automotive, but the F-150 EV market did strike me as a very thin slice of two circles that you would overlap. So I must admit, I'm not hugely surprised that they found that market segment wasn't as big as they initially expected. But what do I know? Every 10, 15 years, Ford seems to have a massive financial crisis.
Well, just crossed into investment grade, so let's fund that expansion. Right, I guess as we are slowly coming to the end of it, we still have a bit to go. There is actually the bonus question, which you already
Oh,
oh no, not the trouble areas.
No, well, it's something we touched upon slightly beforehand. So I guess I would probably even put it into two layers, if I can. So one is, I understand you guys have your own central view that you expect things to take. Then I wonder is there any part of your asset allocation that seems a bit more optional, more not necessarily reflecting the central scenario, but say, for example, is there a part of your portfolio that is meant to hedge shock in interest rates, for example, or is there a part in your portfolio that is trying to get ready for a geopolitical shock, for example, that might be not necessarily, without that risk component, necessarily the best of or like the savviest of investments that you would do, either because carry is not great or it doesn't look too good. But what do you keep as kind of edge, or to kind of contain the variance within your portfolio?
I'll tell you what, look, like any investor, I've got lots of big question marks. The thing I'm struggling at the moment would be commodities. So per se, I don't really like them as a standalone investment class, but I'm not a commodity specialist, so I tend to stick closer to stuff that I understand. But the thing that I have with that is, my base case is we've got a world that looks a lot more like the 70s. So dig out your flares, everybody. But then commodities largely did okay. But then the counter sort of force to that is the world's biggest consumer by far of commodities over the last sort of 20 years has been China. And a lot of that ended up in the construction industry, which I think we can all agree has got some slight problems at the moment. And I'm not quite sure how you reconcile that, because if I think that the world's sort of heading into a 1970s-ish like scenario, I could see some value in commodity-linked equities. But if at the other end of the spectrum, I still think that perhaps China was massively over-consuming commodities, then I could see that really pushing back against my kind of core view. And China is kind of trying to export to a certain extent. I know I'm simplifying here. It's way out of its problems. I think the world's too small to absorb the level of exports they need to do. But that does also put downward pressure with regards to some of my inflationary tendencies on the goods side of things. So I must admit, that's one of the things I struggle with. And the other thing that I always struggle with is gold, because because I personally, I won't say worthless, because if you gave me a lot of it for nothing, I would be very happy. But I quite like the gold mining stocks as an option on things happening. But the fundamental problem I have is I don't see any value in LVMH handbags, but clearly loads of other people do, and the share price reflects that. And while I think gold is a fairly useless asset, it is a behavioral asset. And I do wonder if we get to a world where people get more concerned about governments and central banks, where it does potentially perform more, even though I view it as largely worthless as a standalone sort of utility factor.
Sure. Luis, I think you were absent for a moment. So just to catch you up.
Yep. Can you hear me now?
Yeah, I can hear you perfectly.
I'm back. I had to switch out of my headphone. It ran out of battery, so apologies for that.
Oh, there you go.
I've been busy. I've been on all day.
In the camera then.
You just proved my point about EVs and battery technology, Louis.
Yeah, work it into the conversation. Why not?
Analog is the way to go. Louis, what we're trying, the question is, and we're trying to assess is, we obviously discussed, central scenarios for all of us. But what I'm trying to understand, and I think it could be for the benefit of the audience, is to what those parts of your allocation that are either more edge-like types or things that have a bit more optionality, and that's why Ben was talking about gold, for example, and commodities. What do you have anything in your portfolio that envisages that it kicks in if, for example, you have an interest rate shock, or you have a new inflation shock, or you have geopolitical conflict blowing up in multiple fronts across the planet? How do you look at that? Two, three standard deviation type of.
Whenever you actually plan for the worst, you also have to invest for the best, if that makes any sense. So we have a portfolio where we're thematic and opportunistic in terms of sectors we allocate to. So this is why the ESG thing was interesting, because we believe oil and gas, we believe shipping, a few other sectors are going to continue to do well with inflationary trends. Now the question is, when you build in optionality to the downside, how much do you pay for it, and how much out of the money do you want to be there? So I would have said gold would have been a great hedge for inflation. That hasn't really panned out that well, right? Nor has Bitcoin. So what we tend to do, so we look at our portfolio and we say, what's the beta of our holdings, i.e. relative to the market? And we can assess beta relative to S&P. We can assess beta relative to iTraxx and a few other indices. We then actually say, at what point do we think we want to hedge? How much do we want to spend, and how far out of the money? So we'll run a series of put options as an overlay on the portfolio, generally speaking, when we think geopolitical, when we think Trump might get into power, when we think AI might fake a World War III and, everyone launches nukes. I mean, I don't know if I want to be investing if nukes are launched, but, there are some pretty wacko scenarios. And I've got a lot of friends that are extreme right and extreme left. As Ben alluded to, I don't know a lot of people in the middle. I mean, besides the people on this call, right? And so how likely are these scenarios more likely? How extreme are these scenarios more extreme? Like global warming, where is the fat tail? It's not 2 standard deviations. The actual distribution now means that the fat tails are 3 or 4 standard deviations, and the distribution of returns is also much wider. So I think you need to be out of the money, but I think you need to be realistic about how fast it can go down. So run some overlays in your principal portfolio, understand the risks, and actually quantify those risks, and hedge yourself methodically over a shorter period of time so that you can take your hedges off if and when you want to take them off. They don't cost you too much. Put options on the S&P, options on iTraxx, bond index options, a variety of things. But I think the bond market's going to be okay, because I think the Fed will cut rates, and I think the curve will flatten, so to speak.
Yeah. Okay.
But when do you think they're going to? The point is when they're going to cut rates, because I mean.
Did you see the minutes today? The minutes from yesterday? It looks like they are not going to cut rates soon, and it looks like the central theme, according to Powell, is not cutting rates in March.
No, we know it's not going to be March. Now we've been told.
Well, we don't know anything, but we presume.
Well, okay, let's presume then. All right, we're presuming June at the earliest.
Look, I think they maybe do a small cut in late June. When are the meetings? March, June. When was the next one? September?
Yeah, well, this is it. And then we're going into sort of the second half of the year.
I mean, look at the dot plot, and you can usually figure out what people are thinking. I guess the question is, I don't think not cutting rates quickly is a bad scenario. I think it's the States is still growing, right?
Yeah.
So I think Europe actually having to cut rates really quickly is much more of a dangerous scenario, because Germany is in such bad shape economically, right? and it's what, 60% of European GDP in growth usually, something like that, right? So
and how are we going to fund France with the state that Germany's in?
How are we going to fund France? What about Italy's deficit, right? I mean, that's what, in the 200s now. So, debt to GDP is one of my concerns, but that's why I asked the inflate out of the problem question. We're going to have a lot of debt, right? So refinancing debt might stay expensive even if rates come down.
Definitely.
And the curve steepens on that, maybe.
Curve steepness, but also a curve spread of product over risk-free rates across the world. If you start losing, the thing that we played in 11 was a dispersion between Italy, Spain, and Germany in terms of bond yields, right? We played that dispersion of being long Italy, short Germany, and playing the contraction. Okay, that's if Draghi comes in and says whatever it takes. But if everybody's working independently and their fiscal and monetary policies are disjointed, then countries can actually get really out of whack relative to each other, and there's not much you can do about it.
Thank you, Louis. That's a great tail. That's another tail risk, I guess.
Can I just ask it very quickly, because Louis and Ben, very quickly on it was Louis you mentioned about Bitcoin. We used it to protect against so digital assets. Let's say in a portfolio averaging now still 2.5 to 3%.
Family offices love it.
Going.
Family offices are big buyers. They have a statistically higher percentage ownership
of their portfolio in digital assets.
Public. I think they're 6 to 11% on average. Family offices.
Well, it depends, because that's come down. It's not really between 4.5 and 6 now. So it's not on mean value, average.
Yes.
Okay, going across, but they haven't performed as inflationary hedges at all, really. And I just was thinking.
But Bitcoin, you're in the basement. If you're in the basement with guns and water, the world is ending.
There's no electricity for your Bitcoin there.
You want the Bitcoin with you as well, right? I mean, joking aside, what's the currency you're going to take down to the basement with you?
It's barter.
It's not gold. It's not gold, because you can't send gold to China so they ship some food to you. But you can send Bitcoin, and China will send you some food if logistics still work, or ammunition, or more water, right? I'm joking. I'm making a horrible scenario, but the currency that's going to actually be global in a meltdown scenario will be Bitcoin, because it's crypto. You can send it. No one knows who's doing.
How are you going to send it?
Huh?
How are you going to send it?
Electronically.
In the scenario you're setting up, in the sort of end of the world scenario, Louis, that you're setting up, you're not going to be able to send it, are you? This is the problem.
No, but that's the extreme scenario. But in the less extreme scenarios where things are bad, but there are still some functional infrastructure, you still will have the ability to probably buy something using Bitcoin and have it shipped to you. I mean, I'm talking here. Well, let's hope it doesn't happen. But I guess my point is, when does Bitcoin become impressive and a really good currency of exchange?
That will be a great topic for our next webinar, because we really.
Oh, no, I want to hear it. I want to hear.
No, it becomes a medium of exchange when all the others, or you lose confidence in your country, you lose confidence in Italy or Germany or the US because of its monetary policy, its debt burden, and you actually don't trust the bigger powers to run their economies and run their monetary and fiscal policies well.
So I've learned in my career recently, there's 3 sets of people you should never try and upset, and that's the crypto crowd, the Green Lobby, and London cyclists.
I don't think I've upset them, Ben, right?
No.
And London cyclists.
And London cyclists. So the thing I would say is I wrote quite a long piece on Bitcoin for the CFA, the Chartered Institute of Financial Analysis. It's called No, Mr. Musk, Bitcoin isn't cash. So for anybody that really wants sleeping, I kind of laid out where I see the arguments around it, and it may shock people that I wasn't hugely constructive about its long-term prospects.
No, I mean, nor was I.
That's interesting.
And nor was I. And I still am not. I still think it's a medium of exchange that's more valuable if everything else is breaking down. And that's my point, right?
Sure. Sure. Perfect. Guys, Olivia, you want to leave us with a final tail risk for
No, I am not, because I'm now thoroughly depressed.
That's perfect.
I'll invite you to my basement. I mean, if you
hey,
PM me afterwards, right?
Well,
No, I've already got my basement. Yeah, I haven't got a basement. I've got a whole mansion set out, you know, underground with
in
tin
San
food
Francisco,
and...
next to the Bay Bridge. Is that where
On-
your place is?
No, this is
that
so that you
note,
don't see where I am, you know. So my private secret location, bunker location.
on that note, we are approaching International Women's Day.
Oh gosh.
Evenco is putting out an interview series with influential women out there. So please bear that in mind and you know, check your inbox for that. There's also a new feature on the newsletter, on the March newsletter. Is going to be called Fund Watch List. So please watch out for that. Panel, thank you very much. And for the audience, I hope you enjoyed these as much as we did. And from my part, I must say that, well, you know, when I got here, I was confused. And having listened to this panel, I am still
even more confused.
but at a higher level. So I'm really looking forward to doing this again. And please do get in touch.
Thank you so much.
Thank you so
Bye.
much. And